Welcome back to our channel. Now we are discussing on PE multiples in IPO valuations, including types, sector analysis, price to earnings or PE multiple, especially in the context of IPO valuation. Let's understand how PE ratios are used, not just to price IPO, but also how they evolve post-listing. We'll discuss practical challenges, sector-specific benchmarks, and March 2025 data from India's market. So PE multiples, we'll see the basics and the formula. The PE ratio is equal to market price per share divided by earnings per share. PE ratio is equal to market price per share divided by EPS, earning per share. This ratio tells us how much the market is willing to pay today for 1 rupee of earnings. In reality, this figure hides a complex interplay of industry sentiment, future growth expectations, macroeconomic trends, and company-specific factors. In valuation, P is not a number. It is a narrative about the future. Core applications in public issue IPO. How is PE used in IPO valuation? We will see. The investment bankers begin by identifying similar listed companies known as comparable companies. Next, they analyze their PE multiples, both trailing and forward, and then adjust them to account for differences in size, growth, profitability, and risk profile. Typically, IPOs are priced at a discount to listed peers. To attract investors and account for uncertainties in newly listed entities. So these IPOs are priced at a discount to listed peers to attract investors and account for uncertainties in the newly listed entities. What complicates this? Let's say the company has undergone major restructuring or has a limited earnings history. Then even forward PE becomes tricky to apply. So we'll address those scenarios. We'll see the types of PE multiples. So there are 4 types which we are going to discuss. First one is trailing PE, that is TTM PE. Second one, forward PE. Third one, normalized PE. And fourth one, cyclically adjusted PE. We'll discuss one by one these types of PEs. First, trailing PE, TTM PE. Based on past 12 months actual earnings, objective put backward looking. Trailing PE, which we are discussing now, useful for stable businesses, less so for evolving or cyclical ones. So for stable business, generally we use this trailing PE, TTM PE. Second one, forward PE, based on the estimated earnings. Forward looking reflects growth expectations. Heavily reliant on analyst projections, which are often optimistic. In low analyst coverage sectors, forward PE can be misleading. Then the third one is normalized PE. Adjust for cyclical fluctuations and one-time items, common in sectors like manufacturing, semiconductors, or energy. Requires judgment to smooth out earnings over business cycles or strip non-recurring items. Fourth one is cyclically adjusted PE. Uses inflation adjusted earnings over 10 years. So more useful at market or index level like Nifty or Sensex than for individual companies. Helps spot long-term overvaluation or undervaluation. Now we will discuss on theoretical interpretation, P ratios. The formula P is equal to 1 divided by R minus G, where R is required rate of return, G is expected growth rate. If company is expected to grow fast, that is higher G, so the P goes up. In this formula, P is equal to 1 by R minus G. G is expected growth rate. If expected growth rate is high, that is G is high, then P goes up. But if the return expected by investor R rises, say due to inflation or risk, P falls. This explains why tech companies with 25 to 30% growth, P's of 40 to 50, while banks may stay under 15. Now we'll see sector specific PE multiples. We'll take March 2025 data. Now look at real data, the PE ratios by sector as of the data as of March 2025. In technology, approximate PE forward 35 to 40, high due to strong growth. In healthcare sector, 35 to 40, defensive plus growth play. Financials, banks, approx PE forward is 20 to 25. Moderate valuations. In energy sector, 20 to 22, that is approx PE forward. Cyclical, asset heavy. This is the remarks. In consumer sector, 20 to 22. Consumer sector, 25 to 30. Consumer discretionary, 25 to 30. Premium for brands, growth. And basic material sector, 20 to 24. Global demand sensitive. If you see overall markets, 21.5 is a trailing, 21 is a forward. Above 20-year average is 17.5. This is approximate PE forward sector wise. And also we discussed about the remarks. And large cap, Nifty 50, approximate PE forward 20, fairly valued. If you see tech trade at a premium due to scalability and recurring revenue. Practical IPO pricing methodology is how the PE multiples are used. We'll see step by step. First, identify comparable public companies. Then analyze their trading multiples. And then adjust for differences. Then apply discount. Then cross-validate. These are the steps. First one is identify comparable public companies, same sector, business model. Analyze their trading multiples, both trailing and forward PEs. And adjust for differences, profit margin, size, risk. Apply discount. Generally 10 to 20% discount is applied to account for IPO risk and lack of trading history. Cross-validate, use DCF and other methods, EV to EBITDA, to validate the pricing range. Example, if peers are trading at 30x forward PE and the IPO company has 10% higher margins and stronger growth, then at 32x forward PE might be justifiable, or still lower if it is a first time issue. Now we'll see post IPO PE valuation. What happens after the IPO? Then there will be initial volatility and multiple expansion, multiple compression. If you see initial volatility, market reprices the company based on sentiment, delivery on earnings, and clarity in guidance. Multiple expansion happens when the company exceeds projections or builds in investor trust. Multiple compression happens despite earning growth if guidance is missed or competitive risk arise. Long-term PE multiples track execution, capital allocation, and predictability, not just revenue growth. not only revenue growth. Now we'll see PE strengths and limitations. Let's now discuss where PE works and where PE doesn't work. We'll see strengths. It is simple and it is very simple. Great for relative comparison across the peers. Reflects market sentiment very well. Limitations, if you see, not useful for loss making or volatile earning companies affected by accounting distortions. Doesn't consider cash flows or balance sheet strength. In such cases, analysts use EV to EBITDA, price to book, or revenue multiples instead. So PE in different business models, different companies warrant different PE logic. Tech companies, recurring revenue, higher PE, banks, regulated, interest sensitive, so lower PE, consumer staples, defensive, moderate PE, discretionary retail, cyclical and brand driven, so fluctuating PE. Revenue multiples are more relevant for pre-profit or high burn startups than PE. So also revenue multiples are more relevant for pre-profits or high burn startups than PE. So the conclusion is PE multiples remain a powerful tool in the valuation toolbox, especially in IPOs. But they are not perfect. Effective application needs sector understanding, forecast scrutiny, and comparison with other methods like DCF or EV to EBITDA. Use PE as a lens, not as a blindfold. It tells story, but you must analyze the plot behind the numbers. Thanks for watching. If you found this useful, like, share, subscribe. We have two channels, RR Corporates and other RR Legal Talks. Please hit the bell icon so that you will not miss any of the latest videos. Thank you.